Welcome to Soundbites, Fidelity's monthly podcast where we talk about all things investments. My name is Lukasz de Pourbaix. I'm Fidelity's global cross-asset specialist, and I'm pleased to be joined by Dmitry Solomakhin, one of Fidelity's global portfolio managers who manages money all around the globe, including in Australia. Welcome, Dmitry.
Thank you, Lukasz. Thanks a lot for having me here.
And so you're in Australia for a week, meeting with a variety of clients and so forth. But one of the things I'm always interested in is how people get into this business. And your journey is very different to many other people's journeys in terms of investment. So from Moscow originally, and tell us a little bit how you made your way all the way to London from Moscow via, I think, a whole bunch of different places, ended up in investments.
Yeah, basically, it's been a long journey. I've been at Fidelity for quite a long time now, about 19 years or so. And for me, it was a career change. I was doing IT technology before. Yeah, I graduated from the Moscow State University in 99. We defaulted in 98. It was a financial crisis. So the best thing I could do was find a job in Poland and Warsaw. Spent 2 years in Poland, then another 3 years in Germany working as SAP consultant.
Mm-hmm.
And then went to a business school at INSEAD in France. That's when Fidelity interviewed me, and the rest is history.
The rest is history. The rest is history. That's probably a good segue into how you think about investing, because you do have a very distinct and interesting view on investing, and one of the ways your investment style is described as is a contrarian investment style. And I would argue that your very different journey into investments fits in very nicely with that contrarian investment style. So when we think about contrarianism, it's sort of moving against the herd. And how would you describe the way you think about investing?
You invest the way you are. It's not about being contrarian. It's not like I wake up every day and try to think, how else can I be different? Mm-hmm. How else can I be contrarian? It's not against the herd. It's just, the thing is, when you invest, it's one thing is to get, obviously I'm bottom-up stock picker. Mm-hmm. One thing is to get the fundamentals of the company right. Mm-hmm. But it's only a very small part of the job. You need to understand what the market is thinking. So where you are versus where the market is. Mm-hmm. And in a sense, you can be completely wrong in your investment thesis. But as long as you are less wrong than everyone else, you'll do very, very well out of it. Mm-hmm. And then the industry is very competitive. Just to give you an idea, if I look at my peer group, it's maybe 600, 700, 800 funds in the Morningstar peer group, global diversified funds. And over time, over the long term, the benchmark is beaten about between 80 to 90% of the peer group, net of fees. Mm-hmm. So it's not a great place to start, right? When you start running global diversified money. The idea would be what you try to do, you try to find a niche where the odds can be slightly kind of more in your favor, so to speak. And for me, it just happened to be contrarian because I think there's a big element of psychology involved. People feel deeply uncomfortable trying to invest in this kind of names because it's a high career risk, because you can't necessarily time your investment. So, and then in a sense, I just find it less competitive. That's what it is probably. It's not just about being contrarian for the sake of it.
Yes, so certainly in my time in speaking to different fund managers, I think that comment you make about being in your DNA, certainly for contrarian investment, is very true. I don't think it's something you just can fake it. It has to be part of you, because as you say, you can be wrong for a long time before, those stock theses come to fruition. So if you think about the ideal, if you take that concept of contrarian investing, what is the ideal type of company in your eyes? Because for a traditional sort of investor, they want sort of strong earnings profile, growth, long-term growth, all of those things that everyone sort of wants. But when you're a contrarian investor, it tends to be a little bit different.
So basically, the starting point probably is exact opposite. If I look at my long positions, it's typically companies where the market takes a view that the business model, the franchise might be broken. They might be having some operational issues, financial issues, balance sheet related issues, quite often corporate governance related problems. Usually it's a mix of these things. And most of the time when the market looks at it this way, it's absolutely correct. So if it's been priced as a broken business, it is a broken business. What I'm trying to do, I'm trying to find those cases where there's a turnaround potential when the market believes that there is none. And that becomes basically my loan book in the fund. It's quite difficult. A lot of manual work, basically name by name, day by day. I always say these turnarounds take years, sometimes 3 years, 5 years, sometimes even longer. You have to be very, very patient. But over the long term, it works quite well.
If you think about those turnaround companies, and obviously they're all different from each other, they're not all the same, but what is the most common area that you sort of tend to focus in? And I know in the past we've talked about things like governance, we've talked about things like management teams and all of those things. And to me, it's sort of sometimes it's like a sporting team where you've got a sort of, the core is okay, but maybe you don't have all the players you need. Maybe the spine of the team is not there. Whatever it is, you need a new management team. It feels like they're the sort of companies you're looking for where there's something there that needs sort of fixing. So maybe talk about some of the management teams, because I think that's an interesting one. You quite often see companies where, maybe there's a poor management team and you follow their history over time, and it's sometimes a pretty good indicator as to what to expect in the future.
Yeah, I guess, again, taking a step back, the key thing you need to believe in is that the core of the franchise is still intact, that it's a good quality company. And maybe the market misunderstands it today because of the issues the business might have had over the past, right? But you need to believe that it's turnaroundable. This is key, because most of them, again, they are not really. The market thinks is broken, it is broken. And if you find something that in your view is turnaroundable, then the next question is, does the company acknowledge that there is a problem? Because sometimes they don't. And then the next question is, do I think they are capable of fixing it? And that's where the management team comes in. And quite often, I'd say most of the time with my companies, I would go through a management change. Call it, I don't know, 90% of the time, perhaps.
Right, yeah.
Quite often, the company will also go through a significant board refresh at the same time. We are usually quite involved in all these processes. We are not vocal activists, but we make our views known, usually behind the scenes. We don't publicize them.
Yeah. Yeah, so absolutely. So, it is a people business, and management teams are very important. Now, one of the things you referenced is shorting. Now, if you think about your typical investment, you try to make money from a stock going up in value. Shorting is effectively the opposite. You're looking to make money from stocks falling in price. Can you just describe shorting briefly, and what type of companies do you look for there?
Yeah, shorting is a lot more difficult than long-only investing. Because to your point, Lucas, we are in the market because we think the market is going to go up. If you thought it was going to go down, probably you would not be in the market. You would be doing something else. So shorting, again, you are going kind of against the general market trend. On the other hand, it's quite difficult to be 100% contrarian doing shorting, because when position goes against you, when you are short, the size of the position grows. You have to pledge collateral, with your counterparty. And it becomes very painful very quickly. In terms of the types of companies that I short, remember I mentioned I look at potentially broken businesses anyway. It's a good universe to look for short ideas as well. If I take a view it's a broken business, I can put it in my short book. But also, what's been happening over the last 4 to 5 years, thanks to very kind of loose monetary policy, all this money printing, very low interest rates, we had a lot of areas where I would say we saw market excesses that led to kind of bubble behavior. And it was a great opportunity for me to go and short a few things there. But then you have to be patient and control your position size very carefully, because bubble can keep on growing, as we know.
Absolutely. So, just on that, because, one of the interesting things is, because you just mentioned there, is that, you can get long-term, you may have a thesis that, there is a bubble and so forth. But as you say, that can last longer than you expect. So how do you manage that in terms of the short book, in terms of, things are going against you? How do you sort of manage that? And how do you keep your nerve, to be honest? Because unlike long investing, shorting, in theory, you can lose a lot more than just the capital you put in.
Yeah, you have to operate very strict stop-loss policy for the positions that you've got. You have to manage position sizes very tightly, dynamically. But again, you need to remain patient on the other hand. Not all bubbles are the same, of course, but there are many similarities. As someone who used to run technology fund many years ago, I've seen a lot of this stuff. Yeah. So it's nothing new to me. It follows, roughly speaking, maybe similar patterns quite often.
What were some of, just on those bubbles, and we'll go through some of your views at the moment, but just over time, you've been managing this strategy for well over the decade. What are some of the bubbles in the past that you can think of that come to mind?
I'll go way back. You might remember, I don't remember the year exactly, it was still back in my tech days. Remember Research in Motion, BlackBerry, RIM?
Yeah.
If you think about the share price, it was absolutely crazy. Complete mania, you can think about it. Another one, a few years after that, it was GoPro. Something that started as a sort of specialist product for people with active lifestyles, surfing, snowboarding, skiing. It got to the point where brokers were speculating that every cat and dog will have GoPro attached to the lead so that you know what's going on. It's just crazy. So things like that, and I can go on and on. There are quite a few of these things.
So I think it's sort of that exuberance around. There's a theme. There's some, I guess, validity to the theme, but then the market gets overexcited, and that's sort of the term used, sort of irrational exuberance that you see.
Yes, that's a great point, because usually, as you said, that's exactly right. The theme is almost always valid, but within the theme there are things that make sense. And a lot more things that don't make any sense from the market capitalization point of view, from the valuation point of view. That's when the sentiment gets ahead of the fundamentals. And that's when it becomes very interesting from a contrarian point of view to take a look at the short. But again, you have to size the position accordingly and manage the stop loss quite tightly.
Yeah, but again, I think it's an interesting example where the psychology of this style of investing, I mean, I could imagine it's a very difficult, or can be a difficult decision to take this position against the market, where the market is just, all the news is positive, the newspapers, there might be positive news every day in the papers, and yet effectively taking a opposite position.
Investing is difficult, full stop, but if you do it full enough, what you find out is basically the best trades are those that are uncomfortable trades. When it feels really bad, is probably good. If you look back at it a few years later, vice versa, if it's a feel-good trade, chances are it's going to lose you money on the medium to long-term view. That's my experience.
It's sort of that sort of short-term gratification.
Just psychology, right?
Again, psychology.
Human nature, market psychology.
Absolutely. So if we think about the market at the moment, it has been a very interesting market. If you look at global markets in particular, it's been a very narrow market. There's been certain parts of the market that have really driven a lot of returns over recent years. And if I reflect on the US market, that's been a classic example where for some time up until recently, you had these group of tech stocks, some refer it to the Magnificent Seven. They've really driven a lot of the market in the US. So if you strip those sort of 7 stocks out, the broader market hasn't done as well. But, those sort of AI tech-related stocks have done really well. Talk to me about that sector, because I know, number one, you have a strong background in that sector in technology, but also the interesting thing is, if from your investment, you've taken a very contrarian view more broadly on that part of the market. So step us through some of your thinking around that.
Maybe before I do this, I just want to step back. I think it makes sense to spend a couple of minutes just thinking about the US market overall, because the market has been changing quite a bit over the last 5, 7, 10 years perhaps. For example, we ran some statistics, basically trading volumes as per Bloomberg, as at the end of last year. Take a guess. So if you look at the long-only mutual fund industry, take a guess, what was the total trading volume that was associated with us?
No idea.
Pick a number.
Don't know. You tell me.
8%.
8%. Wow.
8%, yeah. 8%. Wow. Fundamental hedge funds, quite high, maybe low double digits, call it 11, 12. Retail, 17. Passives, 30. It tells you a lot in terms of what's going on in the market, what's driving the market, what's happening with the time horizons in terms of investing, right? You need to take all this into the account. The other interesting kind of observation would be, I don't know if you're familiar with 0 days to expiry option strategies.
No.
That's basically when you start a position in the morning and close it before the market closes the same day. That's why it's called 0 days to expiry for options with leverage. In some sectors, particularly in tech, it now accounts for maybe over 60% of total options value in a given day. So it's not investing, it's like a casino. In a sense, right? It's gambling. That's what it is.
I mean, so in a nutshell, those two indicators, I mean, they do sort of signify there's a lot of speculative investment at the moment. Yeah.
And part of it manifests in Magnificent Seven. I have nothing against the companies per se. Most of them are actually very good quality. Earnings are growing. They have very strong moats, very strong pricing power. But we also need to be cognizant of the fact that flows have been driven by these factors that I mentioned that are not necessarily fundamental. You can justify any share price if you need to. It's not a problem, but things can turn as well quite quickly. I saw a lot of justification for commodity supercycle, housing supercycle back in 06, 07. And look what happened. I'm not suggesting this is what's going to happen now. But, you can look back and see certain examples from the past.
So one of the interesting discussion points at the moment is this, the discussion around AI and the extent to which it's going to impact, everything that we do, ranging from work just to our daily lives. And certainly a lot of the stocks that have got anything to do with AI have benefited from that sort of narrative. And it sort of takes me back to that comment earlier that we talked about, that a lot of these stories, there's actual something behind them. It's not just fluff. There's actually a real sort of catalyst there, but the market can get over exuberant. So what's your view on AI? I mean, are you a believer, or are you, do you think it's just sort of overplayed?
The trend is real. It's a very good productivity tool. Maybe in some cases also a good revenue generating tool. For sure it's real. But most of the technology trends would be like that. Think about the internet, fiber optics. Think about back to personal computers. It's technology is absolutely real. But again, we have seen similar things over the last 5-10 years. If I go back to, for example, electric vehicles, the trend is real. EV penetration will continue to go up for sure for the decades to come. But at the same time, you can think of quite a few EV names that basically have gone bankrupt because you need to differentiate between those who will win and those who won't. And in any kind of hype cycle, in any new theme, you have very similar patterns. AI won't be an exception. There are companies that will win, but then the question is how much you're willing to pay for them market cap-wise. And there are companies that are jumping on the bandwagon but won't be around on the longer term view.
So if you think about some of your contrarian views, so certainly in that tech sector, you have been underweight and overall underweight the US, which is quite interesting. But if we sort of flip it to another part of the market, which arguably you've got a little bit of a contrarian view, is around China. So if we think about China, we know the market has sold off aggressively, certainly over last year, as there's been concerns around the economic growth, policy, all these sort of things. So you've had a indiscriminate selling really of that market over the last sort of 12 months or so. There's a little bit of a bounce back at the moment, but certainly there's still a lot of nervousness around China. Talk to me about China in your view, because I know you've been sort of building that position over time, and just your thinking there.
China is a very difficult market. I've been looking at it maybe for the last 15, 16 years. Last time I was overweight China, it was back in 2014. So a long time ago. And my current overweight position I've started building maybe a bit less than 2 years ago because exactly as you said, people just didn't want to touch anything that would be related to China because of the tensions, Taiwan-related tensions, because of US sanctions, because of the housing crisis, because of domestic policies, many good reasons not to get involved. Consumer obviously very, very weak post-COVID lockdowns. But then you start looking at the companies and some of them are quite decent quality. Significantly undervalued, generate very good cash flows, and what's even more important, they return you a significant portion of this cash flow that they generate. So as a result, now I'm probably sitting on a fairly significant overweight. I talk to my global peers, most of them say it's just too risky, it's a career risk, you can't really touch China. So to me, it's a very good contrarian indicator.
Brilliant. So it's sort of the key term there is I like that you say when there's career risk, it sort of looks interesting to you, doesn't it? So
yeah, because again, it's psychology involved. Because career risk has nothing to do with company fundamentals that you invest into.
Absolutely.
It's your fear.
Absolutely, it's fear. Absolutely. So if you sort of reflect on how you invest, so contrarian, you take long positions, you take short positions. From what you've described, you look very different from a benchmark, your portfolios. What type of environment do you expect this type of strategy to perform well in? What's that sort of ideal, those three ideal things that you think makes this type of approach of investing look attractive in terms of returns?
So maybe let's start with the negatives. Basically, because I don't look at the benchmark at all, the worst possible scenario for me is the benchmark going up a lot, because then I just need to try and keep up best I can.
Just treading water.
Exactly. And because I'm contrarian, I'll never own anything that goes up in the benchmark, none of the mega caps. So that's the most negative scenario. On the other hand, if I'm in a bear market or if volatility picks up, if the market goes sideways, then it's fantastic. Because most of my ideas are very idiosyncratic anyway. They do what they do. And then if the benchmark is going down, it's only better for me, relatively speaking.
Yeah, brilliant. So you sort of, when the market's sort of trending up, you're sort of swimming against the tide. But then, when you get that dislocation and maybe some of that momentum in the market breaks, that's really when this sort of strategy can come to fruition.
Yes, and the idea would be kind of twofold. Try not to lose too much money when the market is not in your favor, which pretty much has been probably out of the 10 years, 7 or 8 years was like this.
Right.
And then you try to generate a lot of alpha when the market is in your favor. And then you put the two together and hopefully the long-term track record looks all right.
Well, that's great, Dmitry. Well, look, thank you very much for stepping us through your thinking about how you invest, contrarian investing. Certainly very different from a lot what's out in the market and certainly complements a lot of the more traditional sort of approaches to investing. So thank you again, Dmitry, and safe travels.
Thank you, Lucas. Thanks a lot for having me.
Thank you for joining us in this month's podcast. If you'd like to subscribe, please reference your favoured podcast platform. Or if you'd like to provide us feedback, please email us at podcastaustralia@fil.com.
This podcast is issued by Phil Responsible Entity Australia Limited, AFSL number 409340. This podcast is intended as general information only and has been prepared without taking into account any person's objectives, financial situation or needs. Please note that past performance is not a reliable indicator of future performance. You should consider the product disclosure statement and target market determinations for Fidelity Australia products available at fidelity.com.au.